Good Monday morning. We are following a tough market story this morning. Across the globe, equities are selling off yet again. When will the selling stop? When will it be time to find opportunities? Joining us right now on the phone is Rogers Holding Chairman Jim Rogers. Jim, thanks very much for weighing in. What's your take on this global rout in stocks this morning?
Well, Maria, it's long overdue, as you know. And first of all, second, we haven't had a 10% correction in the New York Stock Exchange in, 4 or 5 years?
Yeah.
So this is not much of a correction yet. We still aren't even down 10%.
Well,
it looks bad, but
we've seen really Asian markets set the tone. I mean, I guess maybe we needed to see a correction because we haven't had one in so long. But do you think it's warranted that China would really spark the sell-off? And China continues to deteriorate right now. 8.5% sell-off last night.
Yeah, I see that. I hardly see how Chinese stock market, since virtually no foreigners are invested in the Chinese stock market, I hardly see how this can all be blamed on China. The Chinese currency is down 3%. Well, my goodness, most other currencies are down a lot more than that. I'm in China at the moment, so I'm a little perplexed that China's getting the blame for all of this.
So to what do you attribute this then, Jim? I know you said we haven't had a 10% correction in a long time. Aside from just the fact that we haven't seen that kind of selling in a long time, what else is causing this unrest?
Well, if you ask me, it's the Western central banks we've all been floating on a gigantic artificial ocean of liquidity, Maria. The Japanese, the Europeans, the British, and the Americans have been printing staggering amounts of money. We have these artificially low interest rates, and now we're paying the price. And we haven't really started paying the price yet because, as I say, markets aren't even down 10% yet.
Jim, where do you think commodity prices go next, in particular oil? It seems to me, in fact, if they keep falling, then the central banks keep interest rates as low as they are, and this financial bubble that you talk about continues.
Well, yes, it seems to be that way. What's going to happen is, I don't know, was that John that was speaking or Anthony? Anyway, it doesn't matter. What's going to happen is, as the markets go down, I don't know, 9%, 13%, you pick the number, people are going to be calling up Washington and saying, oh, you must save us. Well, the people in the central bank they're academics and bureaucrats. They don't know anything. They're going to panic and they're going to do something. I don't know what they're going to do. And then the market's going to hit a bottom. We're going to heave a sigh of relief. And the markets are going to start rallying again. But that's going to be the last rally, Maria.
Yeah, Anthony.
Whoever.
I'm with Anthony Scaramucci here. Jim, go ahead, Anthony.
Jim, you spoke at our conference in Singapore 2 years ago talking about the growth in Asia and this being Asia's century. Where do you think we are right now? Do you think China will be able to dig itself out of this?
Well, the difference now in the last time in 2008 is that China in 2008 had virtually no debt. Now they've built up some debt, so China's going to be affected more this time around than they were before. But the Chinese debt is nothing like the rest of the world, the Western world, or even the Japanese world. And I would remind you, Anthony, as we all know, China's not had a recession for a long time. That's abnormal. So the Chinese are kind of, what would be normal is for China to have a slowdown or even a recession. Now, that, of course, would shock the world and shock financial markets. But as I said before, the financial markets need some shock. We haven't had any problems in the financial markets in a long time, and that is abnormal.
If the Federal Reserve doesn't raise rates in September, Jim, is that a bigger negative for equities than if they were to raise rates?
Well, if they raise rates and markets go ahead and make this 13% or whatever downturn, then they would panic and then they would come riding into the rescue.
And
the rates are so high, Maria.
Yeah.
We got to pay the price for this artificial ocean of liquidity, and the sooner the better, if you ask me. I don't like markets collapsing either. I can see it, my longs are down like everybody else. But the longer we delay this, the worse it's going to be in the end.
Hey, Jim, it's Dagen.
Hello, Dagen.
Hey, Jim, what if the Fed comes in to rescue this downdraft in the stock market and whatever they decide to do doesn't work? Is that a possibility?
Oh, that would be good news. That would be good news because then the markets would finally, have some reality. We would hit, it would be a bad market. It wouldn't be fun. And some of us, including me perhaps, would lose money. But it would be a good dose of reality we would get interest rates back to some kind of normal level, and we would have normal levels in the stock market.
Jim, real quick, you buying anything here? You buying anything here, Jim?
No, I'm looking, I'm watching, I'm in China. The one good news that I see in China at the moment is that apparently the Chinese government, and I don't know for sure, is that they're going to stand aside now instead of trying to hold it up.
Right.
That would be good as far as I'm concerned.
Well, they're still promising real liquidity. Jim, great to have you on the program today. Thanks for your insights.
Thank you. Bye-bye.
We'll see you soon. Jim Rogers in China this morning. Coming up.